Marcella, Melanie, Nana, Nick, Nicole, great. Timmons, we got some, like Brigitte from Ottawa. Awesome. Lisa from Innisville. Welcome. Thank you so much. We're just doing the final check here. Zach from London. Surprise, surprise. All right, Zach. Glad to see you here. Nicole's from Milton. Awesome. Thank you so much, everybody. We're going to be beginning in just about 60 seconds here. And just want to thank you all for your time and your energy. Burnaby, Graham. Awesome. Perfect. All right, all the speakers. Everybody's good? All right, welcome. Thank you for joining, everybody. Do me a favor in the chat box. Let me know how many of you here, either by raise of the hand, you'll see the hand on the Zoom button, by raise a hand or in the chat box. How many of you are an active investor? If you're an active investor, type active, just so we can get an idea of who's in this room, so we can make sure everything's tailored to you. Well, active, active, active. George is active. Awesome. And how many of you are learning? And you're not an active investor yet, but you're here because you want the knowledge, you want the experience. If you're still learning or you're just starting, just type "just starting" in the chat box. Looks like we have a lot of active investors. Jennifer Elliott, great to have you. George, just starting, Marla. Perfect. You're in the perfect spot. Awesome. Thank you. So today is all about maximizing cash flow. So thank you so much for joining us. We're going to do our absolute best to make sure that we can show you a few key factors when it comes to your investing, such as converting non-deductible mortgage debt into taxable debt. Or how many of you would like to achieve high income and low hassle cash flow? How many of you would like that? Achieve high income with low hassle cash flow. Anybody interested in that? Say me in the chat box or raise that hand on Zoom. Or we're going to also focus on securing hassle-free tenants who have skin in the game. No more of that LTV crap if you're out of Ontario, or tenants that are feeling entitled and all the stress that comes from them damaging your property. How many of you would like that? Look, let's be honest here. I do fully know that's 6 o'clock at night for most of us in the Eastern Standard Time. Some of us it's a little later, some of us a little earlier. So I really do appreciate your time, appreciate your energy, appreciate all the comments we're getting on the chats and for all the involvement. That's why we're going to do absolute best to bring you the facts, to bring you really strong, cool strategies that make an impact in today's market. But rather than take my word on it, let's get the experts involved. So let's start. Nick, do you mind introducing yourself? Tell us who you are, what you do.
Thanks, Jason. First of all, I love the energy, man. That was fantastic. So, everyone, my name's Nick Cox. A little bit about me. I'm the national director for the Smith Maneuver Certified Professional Network. So, I work really closely with Rob Smith. I'm a mortgage broker, so I primarily help clients with specifically with the Smith Maneuver, and what I'm going to be sharing with you today, which is the specific element of the Smith Maneuver called the cash flow dam. And I co-founded a training company called Strategy Hub. Oh, Nicole, nice to see you. I co-founded a company called Strategy Hub, and we educate about 600 brokers on advanced mortgage planning. So, yeah, happy to be here. And thanks, Jason. Over to, I guess, the next guest.
How about yourself, Monique? Do you mind jumping in? Let us know who you are. What do you do?
Hi, everybody. I'm Monique. I'm a CPA CA for my sins. No one, I'm grey. I'm also CEO of Anchor Retax. I serve as a CFO for Wellshare Group of Companies, and I also act as a trustee for a private REIT called Wellshare Real Estate Trust. In my work, I focus more helping people like yourself maximizing your wealth through smart tax strategies and efficient real estate investment ways or structures. Today, I'm excited to share with everybody the practical tools and strategies that you can use to help grow your wealth and keep more of what you earn.
Excellent.
Right, I'm going to pass it on to Andrew.
Thank you, Monique. So I have more in common with Monique and Nick this time around. I'm now a Smith Maneuver certified professional. I've been doing this informally for about 10 years, but I've been using accountants to do the implementation. So now I'm getting involved with the nitty-gritty side of things. But my main role is as a mortgage broker. I've been working with real estate investors for the past 10 years, and that's kind of my specialty. Before I did that, I used to own a rent-to-own company. So this particular topic is right up my alley because it's going to be a combination of rent-to-own and Smith Maneuver. So yeah, I'm excited to dive in and see how I can help everyone out. I guess I will pass it back to Zach. Everyone knows Zach.
I'll take the reins there if you don't mind, Andrew. Appreciate it. Thank you so much. My name's Jason. I'm Zach's business partner. I'm a business strategist, I guess would be the best way to put it. I help turn assets or investment portfolios into assets, or businesses into an asset instead of a job. Also co-owner of Rent Live Own with Zach Cahill, of course, and a number of other different areas. But it's all about building the asset column. And of course, rather than spend too much time on that, let's jump into Zach. You haven't been touched on yet. How about you take the way? Start with the what you do, who you are, and set the foundation for this whole thing. Because let's be honest, you brought us all together. So let's hand the show over to you.
Thank you, Jason, and I appreciate everyone jumping on. I'm super excited. I can feel the energy. And if you guys don't have your camera on, feel free to turn it on. Lisa, Jason, Jennifer, Nick, it's awesome when you actually have real investors that you're working with on the Zoom call. So I'm definitely more excited than normal for this call. So as many of you know, my name's Zach Cahill. I'm the founder of the Real Estate Hub, full-time investor. I've grown a portfolio valued over $40 million in the last 6 years, but not alone, guys. It's been through working with strategic business partners like Jason and strategic people on the team like Andrew, Monique, and Nick. That's Monique and Nick. That's a funny play on words there. That's really accomplished my success. So as we're going through this, guys, it might be a little bit new information. My part here is I want to tell you guys a little bit about my story, dive a little bit into the rent-to-own strategy itself, and then walk you through one of the latest rent-to-own projects we've done before kind of getting into the really meat and potatoes of the event here. So as many of you guys know, I actually didn't start my rent-to-own journey real estate investment journey through the rent-to-own investment strategy. So, show of hands on the call, is anyone familiar with the book Robert Kiyosaki, Rich Dad Poor Dad? Show of hands in the chat. So back in 2014, I was employed as a full-time paramedic. Didn't know anything about real estate and didn't know anything about business or mortgages or anything like that. And it was about 2015 where my paramedic partner that I was working with at the time, he came into my little cubicle office, you could call it, at my ambulance headquarters and slapped down Rich Dad Poor Dad on the table. And after reading that book, I knew that I wanted to be able to use real estate to quit my 9-to-5 job and really to achieve my version of financial freedom. And show of hands, maybe is anyone using real estate right now to look at like achieving their financial goals? Like, is anyone looking to invest in real estate for monthly cash flow to achieve their financial goals? Location freedom was a big one for me. You know, as I kind of share with you guys, this was the location I was working in. Okay. This was a small town, 193 people, it says in 2011. Honestly, I think there was even less people in this town. And this is where I worked. So I basically had put my heart and soul into learning about real estate and different strategies and trying to figure out, how do I quit my job? Like, how do I have that location freedom to move back to London? How do I get that financial freedom to buy the vehicle that I wanted to buy? And the first strategy I was actually the most attracted to was not rent to own. It was a value add strategy. I know Adam's on the call. Are there any other like value add investors in here? Just type value add or the Burr strategy. That was the first strategy that I was really being educated on, a way that you could buy a property, fix it up, and refinance. And I was a YouTube learner. Okay, I love to learn things on YouTube, and everyone talked about, you know, buy real estate, make all this passive income, and then you can quit your job. Okay. So the first property that my fiance and I, we worked on, it was actually a 6-unit property that we purchased back in 2017. Again, just crazy prices back then. We paid $271,000 for this building, 6 units. That's me and my dad. Like, that's the first time I think I ever picked up a hammer, and we demoed the place, got some contractors in, and we turned it from 6 units to 7 units, okay? And a successful project. Like, we bought it for $270 after the refi was worth about $400,000, and we were able to recoup not only the renovation but also the down payment, okay? However, the things that most investors weren't talking about is this was not passive income. Okay, I now had 2 full-time jobs, one working as a paramedic up in Foleyet in the middle of nowhere. I think Adam laughs because it's actually close by to Timmins, if you can see up here on the map. I don't know if anyone else is from Timmins, but one was working up in Foleyet, and the second one was running this damn renovation project, managing the construction, managing the tenants. Okay, so it definitely was not passive. And secondly, the monthly income was inconsistent. And what I mean by that is, guys, we bought a building that was from the 1950s. We only renovated 1 unit, and nothing, no work to the exterior. So does anyone want to write in the chat box like what you think might have happened to the property as, you know, month went over month went over month? The property started needing maintenance. So the monthly cash flow became very inconsistent. And I quickly realized, even, you know, to this day, we've managed to grow a portfolio from 6 units to 7 units, over 200 units in the multifamily space. That did not help me accomplish my financial goals. Okay. So if I backtrack to now 2018, I started learning about other real estate investment strategies, and that's where I fell on the rent to own strategy. And honestly, I like to call it like the ultimate real estate investment strategy for cash flow, or the ultimate cash flow strategy. As many of you guys know, I'm very passionate about the strategy. I'm going to go into it a little bit, but really with the rent to own strategy, I was able to leave my 9 to 5 job and move back to London and live the life on my terms with location freedom. And the kicker was, all right, come close. It was 4 houses that I bought. Four houses. I didn't have hundreds and hundreds of units. It was just 4 homes that were strategically purchased in markets like Sudbury, where the cash flow was very high. All right. So I see a lot of investors that have these goals of, you know, 2,000 a month, 5,000 a month, 20,000 a month, and they think they need to own all of these properties. In reality, if done correctly, that's why I'm excited again to further increase cash flow with Nick, Monique, and Andrew on the call. If done correctly, you can leave your job, you can achieve your financial freedom much sooner. All right. So just show of hands, I'm going to try to pull up the gallery view. Is anyone familiar with the rent to own strategy or done them yourselves? I know Jason's on the call. Andrew, that's not fair. You can't put your hand up. But there might be some of you that have done rent to owns or maybe not familiar with it. But some of the benefits really are coming from the rent to own strategy right now is interest rates are rising, they're falling. It's honestly, this slide should be called the interest rate roller coaster, and it's very challenging to find cash flowing properties in 2025 because of the interest rates and just the whole climate. Okay. Landlord tenant board issues. Is anyone at the LTB right now? Anyone at the LTB dealing with tenants? I think I have two hands up on this one. So again, we'll talk about how the rental strategy really avoids that. Unexpected maintenance and repairs that is really eating into the bottom line of the owning the traditional rental properties. Management intensive, right? Everyone wants to invest in real estate for passive income when it's really furthest from the truth. Market volatility, markets are going up, they're going down. I've talked to guys, all I do is talk to investors and talk to many investors who are truly struggling right now in the condo market in Toronto. I mean, maybe some of you guys on this call have properties located there. And ultimately, even though we have these goals of achieving our financial freedom, our cash flow goals, we end up buying properties that have no cash flow, or maybe worse, actually negative cash flow. So with the rent to own strategy, what we're looking to work with, Jason already said it best, we're working with highly qualified tenant buyers who are putting skin in the game, putting their, in some cases, their life savings towards a down payment for them to buy a home. So do you think they're actually going to be, you know, defaulting on their rent, or like a regular tenant headache that you might have in a traditional rental? The answer is no. Okay, they're really putting their skin in the game and they're motivated to buy the home. They're also responsible for all the maintenance costs, any repair costs, as far as the utilities, the rental equipment, the snow and the landscaping. If you guys have ever been on one of my calls where I'm looking at multifamily deals, there's a massive list of expenses that we're budgeting for. But with the rent to own, it's much more streamlined because it's the tenant's responsibility. All right. And ultimately is what we're really after, guys and girls on the call. It needs to be passive. It needs to be something that can generate you monthly reoccurring revenue consistently without burning all your time trying to be an active investor. Okay. So many of the investors that, you know, are working with us, they do this passively. They might also own a business. They might also be investing actively on their own, but to truly get the passive income, they're using strategies like the rent to own. Okay. It can be done in any market condition. So this is not in any market. I'm a firm believer that you want to be strategic which markets you're doing the rent to own in, but whether the market's appreciating, whether it's depreciating, remaining flat, you can utilize this strategy. We're not going to have time on this call to go into any of that detail, but just understand that it can be used in markets that are going up, going down, going sideways. Okay, so it can be used long term. And really what we're after as investors is the consistent cash flow. All right. So at a high level here, again, I wanted to actually highlight a few people on the call. I don't know if BJ's joined us yet, but BJ was actually, if I rewind back to 2018, BJ was actually my first investor who was not friends or family. So I did my first rent-to-own deal ever with my mother, did the second one with my brother, and the third one was with BJ, who's ultimately like family now because we've been working together for so long. But a real scenario here is after doing, we still invest together to this day. And to this date, I know it says 2024. In 2025 now, he actually has close to over like $900,000 invested in a variety of real estate strategies and is earning consistent monthly income. And I think, BJ, you went to Sudbury one time, if I can't remember, but you did definitely go to Sudbury once to visit one of the rent-to-owns that we had together. Jason is another investor that, we going way back to, I think, 2019, that we were able to purchase multiple rent-to-owns and earn over $4,000 a month in just reoccurring monthly cash flow. And again, passively, not something that he had to self-manage. A deal last share here. We've done, I would say the one difference here is with BJ and Jason, it was something that we evolved over time. Like we bought one deal, and we waited a little bit, we bought another one. With someone like a deal, we literally just closed 4 deals in the last year, right? So this strategy can be used to really accelerate a deal's making over $3,800 a month in passive income. Again, never, been inside his properties, had to deal with any tenant issues, landlord tenant board, any of that stuff. It's just been super passive and consistent. Okay. So I'm going to show you guys a little case study here before handing it over to Nick. Again, we don't have time to dig in the absolute specifics of everything related to the rent to own, but I'm assuming the majority of you on this call are already familiar with the strategy. So this is one way how we're able to work with tenant buyers and investors, and I'm going to go over that specific model. So as an investor with our company, the first thing really you guys are going to see is you're going to get some highlights and some more information on our tenant buyer. You're going to see who they are, why they can't qualify for a mortgage. Again, these are usually high income earners with just 1 or 2 things maybe holding them back from getting a mortgage. So we're going to relay all that information for you. We're then going to jump in to the numbers. So on the numbers, I picked a pretty straightforward rent to own. This is a $275,000 rent to own. And this was done in Sudbury. So the first thing you're going to see on the sheet is you're going to know what is the initial investment. So the initial investment on this deal was $53,000. So it is an entry level investment. I would say on average, we're looking at 50 to 100K per property as a rent to own investor. So 53,000 was the initial investment. Then I like to say in a rent to own deal, we make money in 2 different ways. The first way we make money, the most important, is monthly cash flow. Okay, so on a monthly basis, we're cash flowing $500 a month, $525 a month. The second way is when we sell the property and make profit from sale. Now, the total profit from all the cash flow and the sale is this number right here, just under 30,000. So when we set up these deals, one of the things that, myself included and many investors, the key number is what's the cash flow and what's the return on investment? So when we're setting up these deals, we're on average, I would say, Jason, getting between 17 and 20% ROI per year based on the overall deal becoming successful through the cash flow and also the profit from the sale. And what we're here to share with you guys later are ways that we can increase this. Okay, so on this specific one, we're at 18% ROI. And again, that was over a 3-year period, 36 months, which is a very common rent to own. So next thing we're going to look at is the actual initial investment and how that's calculated. So in this model, as a rent to own investor, you're responsible for putting, number one, the down payment. So the investors are putting down the $55,000 down payment. They're covering the land transfer, the legal fees, there's no cost of the property inspection and the appraisal that's paid for by the tenant buyer. So let's say, the appraisal came back or the inspection came back and we didn't like what we saw, we would just move on to a different property. So there's no cost, no out-of-pocket expense for the inspection or the appraisal. The next line is how the first fee that's paid to our company for doing all the setup work. Again, we haven't really gone into too much detail on like what's involved and how we set this up. So if you guys want to learn a little bit more information on that, maybe just hit us up after and we can go into a deep dive. So our first fee on the fee for service model is this $12,000, and that's paid to us for doing all the upfront legwork, finding the tenant buyer, qualifying them, etc. And the next line is the tenant buyer's savings. So in this example, the tenant buyer actually has $20,000 that they've saved up to put down on a property. So if you have a tenant moving into, let's say, one of your traditional rentals, Jason, maybe just pointing you out here, like what's the likelihood of them not continuing, right? Like they're financially bought into the property because they're giving you $20,000, right? So as an investor, your responsibility is the down payment, the land transfer, the legal fees, the upfront payment to rent, live, own, minus the $20,000 down payment. You're able to use that towards your initial investment, netting the initial investment to $53,225. Does this make sense? Is everyone following? Show of hands. Okay. So that's really the first piece. The next piece we're going to look at is the actual monthly cash flow. So on a monthly basis, we're able to collect $2,400 a month in income. $2,400 a month in income on a $275,000 house. Very high income. Okay. Now the rental income, and we're going to talk about this more as we go on, this $2,400 in monthly income is made up in two different payments. The rent is $2,000 a month, and the savings credit is $400 a month. Okay, so that's how we're getting this higher than normal cash flow is we have two monthly payments from the tenant buyer. Then we're going to be paying the mortgage, the property management fee. So that's the cost to our company for managing the rent to own, doing all the credit counseling, the inspections, the bookkeeping. We're then paying for the property tax and the insurance. Those are all responsibilities of the investor, netting the cash flow to $525 a month. Okay. Again, if you saw me underwriting like a long-term hold multifamily, you're going to see you're going to see vacancy rates here, maintenance, capital expenditures, utilities, snow, lawn. It really just eats into the bottom line. So the rent to own is truly consistent cash flow, and that's what we're after. All right. Again, I won't go into more of the detail. I won't spoil the presentation here, but there are ways that we can even increase that further. Now, as far as the last piece of the rent to own, what happens at the end of the 3 years is you're going to sell the house that originally was $275,000. You'd be selling it for around $320,000. So this is about a 5% increase per year in appreciation. All right. After the sale, you're then going to pay down your mortgage of $209,000. You're going to get your initial investment back of the $53,225. And the remaining here, this is the savings that we've saved for the tenant buyer. So we have the initial $20,000 plus all of the monthly credits, that $400 a month for 3 years. At the end of the 3 years, at this point, we have $34,000 saved for the tenant buyer. So I was speaking with an investor early today, and his number one goal was all about risk aversion, wants to invest in real estate, but don't want to take a lot of the risk. And this is a way that you can really limit your risk as a real estate investor because, our goal in this company obviously is to help families become homeowners, right? That's what we're passionate about. None of this works if they're not buying the home. But at the end of the day, as investors, thinking back when my mom was on literally her last year of work before she retired, I need to be pretty damn sure what happens if the tenant doesn't buy the house, right? And this is a great way to have them financially bought in to buy them house because they have $34,000 in savings when they buy the home. Okay. If they didn't buy the home, unfortunately, they're not going to be able to get that capital back, which has happened before very few times. And again, we do not want that to happen, but it's in everyone's best interest, including the tenants, that they buy the home. All right. So they're able to use this 34,000 to buy the home for 319. All right, that's going to be now their down payment. The last couple lines on here before we wrap up, they're going to pay the closing costs, which is $1,500 to sell the property, and the successful buyout cost to rent Livone for, again, facilitating the deal. Only paid when it's successfully bought out. So that leaves not only the investor getting their $53,000 back at the end of the deal, but also another 10 grand that they can use in their profit from the sale. Okay. And for the sake of time, like honestly, usually I would spend like an hour just on the things that we reviewed, but there's many speakers that we have to go through, and there's a bigger concept to today's call. So if you guys have any further questions on this strategy, please let me know. We can dive further into detail, but this is really what we're looking at. We're looking at, $500 a month passive income to the investor with a profit of sale of about 10,000, which is equivalent to 18% ROI. And again, this has been using conservative mortgage rates, conservative property tax amounts, conservative interest. So typically after we set this deal, the ROI is only increasing. Okay. So we've been doing this. I think, Jason, we've been working together since 2020. I set up my first rent to own deal since 2018. And we started working with Andrew even a few years ago. And one of the things that really came out is I started exploring like the Smith maneuver. And if you guys caught, can't remember what masterclass it was, Nick, but you were on a few masterclasses ago. You're on, and we connected you and with Andrew, and we just really felt like there might be something there, and that's why we're doing this call, because I don't want to spoil your thunder here, but just want to say like we're happy to have you. Appreciate you taking the time, and I'm excited what you're going to share.
Thanks, man. It was that was fantastic, and thanks for having me back. We've been working together towards this for a while now. It was really good. How do I remove? I'm going to share screen this second. So, I was invited. Well, you had Rob Smith come on to do a presentation, and Rob kind of brings me along, and yeah, it was really good to do it with you guys, and I'm stoked that we've been able to continue it. Where should I start? I'm going to share a presentation with you on the Smith maneuver, and I'm going to focus specifically on an isolated area of the Smith maneuver that's very relevant for everyone in the room, called the cash flow dam, which is about isolating a debt conversion strategy related to when you own a rental property and you still have non-deductible debt on your primary residence. So I'll probably cover most of the presentation, but I might throw to Andrew from time to time to sort of weigh in. I'm going to get started, guys. So we'll dive in. Most of my time, to be honest, these days is actually spent supporting mortgage brokers. So a little bit of a backstory here. 2.5, 3 years ago, I came across the Smith maneuver. As you can tell with the accent, I'm not from around here, I'm Australian. And a friend of mine in the broking space, he's like, hey, you should really check out the Smith maneuver. And he convert your mortgage from a non-deductible liability into a tax-deductible investment loan. I'm like, that sounds interesting. I didn't really get it. But then another friend sort of also suggested that I read the book, and I read the book, and I quickly realized, I'm like, you know what? This is actually the best financial strategy I've ever come across in the context of a mortgage plan. Everyone that's on this call has bought into the concept of using real estate to create wealth. The truth is that the mortgage structure enables us to add this extra layer of efficiency, this extra layer of savings, which can help us towards our ultimate objective of growing wealth. So I'm going to dive into the cash flow dam strategy. And the intention with this is that I really wanted to instill in you like a deep understanding of, how this process works and is it relevant for you? So to the ideal avatar, I should say the ideal client, is if you've got a primary residence that still has debt on it and you have at least one income producing rental property. For that person, this strategy is untouchable. If you don't have any non-deductible debt on your home, so think a mortgage on your primary residence, this strategy is not for you. Congratulations, you've got no non-deductible debt. The Smith maneuver is only relevant for someone that has a non-deductible mortgage on their primary residence. So if you're on this call and you're like, I've got a mortgage and I have a rental and I'm not cash damming, then you definitely want to listen in. All right, so all debt, actually let's look at, this is a new slide deck that one of my my team members made up. So let's have a look at what's the content she wrote down here. I like this. I decided this is the first time I'm doing this particular presentation. I'm generally pretty off the cuff. to tell you the truth. So this strategy is a game changer that can dramatically reduce your non-deductible mortgage and supercharge your wealth building potential, 100%. All debt is not created equal, right? Simply put, we've got good debt and bad debt. Bad debt, even though your house is an asset and we live in it, it's technically bad debt, because when we get to the end of the year and we go to do our taxes, Monique is not going to let you deduct the interest costs on that mortgage against your personal income, right? So if we're borrowing for consumption, so think your primary residence, that motorcycle, that holiday, consumer debt, non-deductible. But we also have good debt. Good debt can be characterized as something that gives us a deduction against our personal income. So if you borrow with the reasonable expectation of generating income, buying a rental property meets this requirement, then you can offset the interest as deductible against your personal income. And this can be quite a powerful tool. So how does the cash flow dam strategy work? You might have heard it referred to as rental cash damming. The formal context is called the cash flow dam. And it's part of a broader strategy of the Smith maneuver. There's what's called the plain Jane, and then there's 5 what we call accelerators, which are different ways to speed up the debt conversion process. And that's simply what we're talking about here. It's the process of converting a non-deductible liability into a tax-deductible investment loan. And the cash flow dam is a very effective way to do it. I just mentioned that we're going to transform non-deductible personal mortgage debt into a tax-deductible investment loan. It creates significant tax advantages through strategic planning. The best thing about this is that it adds this extra layer of deductions that didn't previously exist. Those deductions create refunds. We use those refunds to pay debt off faster. Generally speaking, if you want to create wealth, if you want to, for example, go to a financial planner and save for your future, there has to be a delta between your net income and your expenses. If you don't have extra money to save, well, you're hooped, right? This strategy does not require additional cash inputs. It's about creating efficiency within existing structures. And I kind of love that. I love that we're squeezing more juice out of the lemon, the orange, right? That we didn't previously think we could. Again, it requires no new money. So what are the benefits? I'm just going to move the pictures here so I can see the slide deck. Right, you're going to be able to accelerate your mortgage pay down significantly. Create tax deductions, improve your monthly cash flow. This is really relevant. Sometimes you have people, not if you're investing with Zach and Jason, because you're always going to buy a positive or a neutral cash flow property. Sometimes people get themselves in situations where they're negative cash flow. Cash damming can actually help reduce or negate a negative cash flow situation by proper restructuring. And the process is really about redirecting rental property income in a more strategic way. Again, there's no additional monthly payments required. It works with your existing rental property income. So let's kind of go through how that works. When I speak to investors, most of the time, this is how they've got it, right? They've got their rental property, the rental income comes in, it either goes into an account they've isolated for the strategy, or maybe it goes into their general account and it gets mixed in with other things. They then use that to pay their rental expenses. There's nothing essentially wrong with that, but there's a massive missed opportunity. So there's no tax advantage on the mortgage interest, and you're not accelerating the pay down of your non-deductible debt. The way cash damming works is we're going to take that rental income on a little bit of a journey, right? You get the rental income, and we use the full value of the rental income to pay down your mortgage. So let's say you're getting $5,000 a month rent from one of Zach's projects. You take that rental income, you apply it as a prepayment on your primary residence mortgage. Now, we have to have what's called a re-advancing home equity line of credit attached to your mortgage. And what happens is, as you make that extra prepayment on your primary residence, room gets created in a line of credit, and we borrow from the line of credit to fund the investment expenses on the rental property. So and this is the key of what happens here, is if you borrow with the reasonable expectation of generating income, you can offset the interest against your personal income. So you can't make the principal payments on a primary residence tax deductible. Sorry, you can't make the principal payments on an investment property tax deductible, but you can borrow all the money needed to service all the expenses. So we're creating this additional, essentially, line item, this extra deduction that didn't previously exist. Mortgages are for big balances over long periods of time. This subtle change creates a very powerful effect. Right, so let's just talk a little bit about what a re-advanceable mortgage is. I won't spend too much time here. You have to have, the screen's getting in my way here. There we go. Typical mortgage, No recapture of the equity. So you pay down the mortgage and it doesn't re-advance. But with a re-advanceable mortgage, as you pay down the balance on the mortgage, the limit on the line of credit increases by a relative portion. So if you pay, a portion of that mortgage, well, here's an example. Let's say you've got a $400,000 mortgage, non-deductible. Your monthly payments are $2,200. $1,470 goes to the bank man. They keep it. $730 goes to principal. That principal will increase the limit on your line of credit and become available. It's this functioning that allows us to apply the cash damming process because we can recoup that extra prepayment and then withdraw it to fund the investment expenses. So how does it work, right? Each month, you take the 2,000, this is an example, but just random numbers, but you take $2,000 in rental income into a revenue account, it's just a checking account, and you apply that as a prepayment, an additional prepayment on the primary residence mortgage. That will then create $2,000 worth of room in your investment line of credit where it's reborrowed into what we call a Smith Maneuver clearing account or a rental clearing account or a rental expense account. And from there, we service all the expenses on the rental property. Mortgage payments, property taxes, insurance, strata, the lot. And so the efficiency that this creates, let's have a look here. The efficiency and outcomes of your cash flow dam structure will depend on several factors. Okay, so each scenario is going to produce a different result based on the individual client circumstances. Like, what are the revenues and expenses? How positive, neutral, and negative cash flow is the rental portfolio? What's the balance on the primary residence? What's the amortization? What's the rate? Like, there's a lot of variables that will determine the outcome. And I'm actually going to go through and show you the kind of calculations that Andrew and I do when we're working with a client to show them the results. And the cool thing with this calculator is that it allows us to produce very specific results. I can show you precisely when you're going to convert your debt, what your tax refunds are going to be, when you're going to pay off your mortgage sooner. The calculator is quite precise in that. So this is actually a scenario based on, I think this is the pro forma that we just went through, Zach, or that you started with. So here we have a client on the left-hand side, they've got their primary residence. It's worth $1 million, they owe $450, amortization remaining is 25 years, 4.5% interest. 2,500 mortgage payments. Guys, I'm not keeping track of the time. Tell me how long I've been talking for, because I want to make sure that I don't want to go over, I don't want to go too fast. Can someone unmute and just tell me how much time I've been talking for so far?
You're good.
Going at a good clip.
I'm good? All right, awesome. So they've got, primary residences on the left here. They've got a marginal tax rate, in this case of 47.46%, and they own one rental property. Property's worth $275, they owe $220, amortized over 30 years at 5%. And there's your outgoings. So for this scenario, and I'm actually going to break this down in a calculator for you because I like the way the calculator shows the results. On this scenario, if we were to take the rental income of $2,000, apply it as a prepayment on the primary, flow it out through the HELOC to fund the investment expenses, in addition to whatever benefits you're going to get with Zach and Jason on the RTO strategy, you're going to get additional tax returns over the next, well, for starters, we're going to reduce the amortization from 25 years on your primary to 20.58. So without a cent of additional cash flow, you've actually knocked your mortgage down by 4.5 years. Now, over those 20.58 years, and this is a relative, like I'm in BC, the mortgage balances are pretty high over here. So it generally works out to much larger numbers, but just doing this strategy is going to produce $62,000 in refunds from the CRA. Right? So if we're not doing this, we're literally leaving money on the table. So if someone's already got a primary and a rental and they're not doing this, we really are leaving money on the table. And the debt is fully converted in 10 years. So the mortgage has an amortization of 25. We can convert that to zero in 10 years. You're not debt free at this point, but we have converted the debt from the one side of the balance sheet to the other. So just to summarize, over 60 grand in tax refunds, debt conversion in 10 years, 4.5 years off the mortgage, and it hasn't cost us a cent. Pretty awesome. Sorry, Andrew, I'm not going to throw to you, buddy. This is the next show. I might get you to unmute and chime in, but I'm almost at the end, and then we're going to go through the calculator. We haven't rehearsed this. I'm just going off the cuff. The power of acceleration, right? So by accelerating your property portfolio with the cash flow dam, you're going to expedite the pay down of your principal mortgage. It's rare to see this not work very well. Create valuable tax deductions each month and catapult yourself towards financial freedom sooner. I like the word my associate wrote there. The process, right? And this is really key. Professional setup is crucial. So Andrew, myself, and Monique are all Smith Maneuver certified professionals. We've gone through extensive training and ongoing training to make sure that we know how to do this properly, making sure that documentation is clear. Sorry, I'm going to have to stop sharing and cough here for a second, guys. I'm dealing with a very bad cold. One second.
That's why he brought me as backup. Oh,
Yeah, I'm back. Sorry, I didn't want to take too long. I apologize. Previous. Right, so professional setup. Some people try to do this on their own. There's 3 risks to the Smith maneuver. I won't go into all 3 of them. One of them is implementation risk. You really want to have at least one SMCP, Smith Maneuver Certified Professional, in your corner. Good news is you got 3 on the call. Clear documentation is required. Monique will really hit this home. You want to be like dialed in and organized. That's why Monique's fantastic, because she's a CPA that specializes in these strategies. At least annual reviews to make sure that the strategy is still being executed correctly and to make any adjustments to the plan. And it's important to remember this is a long-term strategy. It's not a magic bullet to make you wealthy overnight. Your mortgage is for a long period of time. This is just about applying an additional level of efficiency that didn't previously exist. So your stair step here, or the process, review your rental business structure. We can, check your mortgage eligibility to make sure that you qualify to do the restructure if required. Review your current revenue or rental expenses, and connect. And obviously, you'll get an offer at the end of this call to connect with Monique, Andrew, and myself. But connect with us to help assess, the viability of whether this strategy could be appropriate for you. Yeah, I guess I kind of just said that to get the right support and connect with the Smith Maneuver certified professional. Now, I'm in 2 minds about whether to do this. Can I get like 5 more minutes, guys? Because I really want to show a calc. Some brokers don't like to show the weeds. They don't like to show the calculator. I personally like to show the calculator. Do we have time for me to spend 5 minutes?
If you'd like to see the calculator, put a comment in the comment. Put calculator in the chat below. Let's let our audience decide.
Yeah.
Right, if you want to see the calculator, you want to go into the weeds, see the actual nuts and bolts of this thing.
Calculator. All right. One's enough. All right. I'm good. I'll share it. If one person wants it, I'll show it.
It's
and before you ask, no,
5.
and before you ask, no, I can't share the calculator, right? But I I always get asked that question. All right. So we have different calculators that we use for different scenarios. This is an isolated version. This is an isolated cash flow dam calculator. So it allows us to isolate this particular element of the Smith maneuver. I'm going to talk you through it, okay? There's a lot of data on the screen, but I'm going to work through it. This top left-hand section is the client's primary residence. So we just went through this data. They own $1 million property, $450,000 on the balance, 4.5% interest rate, 25-year AM, $2,500 a month in mortgage payments, okay? Bottom section here is the rental portfolio. Current value is 275. They've got a 220 mortgage, 80% loan to value, 5% interest rate, 30-year AM. 1174 is the mortgage payment. Other associated rental expenses totals 1874.12. Assuming a $2,000 rental income, it's positive cash flow by a small margin. And so as we just went through that process, the way Cash Danny works is instead of using this $2,000 to directly pay for these rental expenses, we're going to take the $2,000, dump it on the $450,000 mortgage, provided there's a re-advancing line of credit in place. And then when that prepayment flows through to the line of credit, we re-borrow it and use it to service the investment expenses. And the right-hand side is the results. Cash damming is done in 3 phases. Phase 1 is debt conversion. That's all we want to focus on. We're going to use that rental revenue to convert this debt to zero as fast as possible. At the moment, it's on an amortization of 25 years. We do this strategy, it's going to convert that to tax deductible in 10 years. Phase 1 is now complete. Phase 2 is once you've achieved debt conversion and you've converted all that debt to tax deductible, the focus then goes on paying off the primary residence mortgage. A lot of people want to pay off their mortgage on their home faster. So just applying this cash flow process and using the tax refunds to pay the mortgage off faster, the mortgage freedom changes from 25 years to 20.92 here. There must be some slight variations in the data, or maybe I just copied it over incorrectly. So let's look at what those results are over 20.92 years. We've got $64,000 in additional tax refunds that didn't previously exist, The process and what allows us to pay the mortgage off faster is that we're using those refunds as prepayments on the mortgage each year. Paying the mortgage off 4.5 years ahead of schedule means that we're going to save $122,000 in future mortgage payments that no longer have to be made. That's 49 months worth of 2,490. But we all know that you don't make your mortgage payments with pre-tax income. You've got to earn your income, pay your tax, and then you pay your mortgage. So the income required from this client to make those mortgage payments is nearly $200,000. So phase one, debt conversion, 10 years. Phase two, mortgage freedom in 20.5 years. Phase three, let's do, if the client doesn't own the property already, and by the way, I've made some assumptions here. I've assumed a rental appreciation rate of 3%. I'm not sure what that is in your area, Zach, but let's look at this section here. Allows me to show what the wealth benefits would be over the original amortization versus doing nothing. So if the client does nothing in 25 years, they're debt-free on their home, but they've got nothing else. With this strategy, what this section shows us is once you've achieved mortgage freedom in 20 years, if you invested those payment savings over those 4.5, 5 years, how much wealth could you create over that time? And the answer is nearly $200,000 of additional wealth, assuming that those savings are invested and they earn a rate of return, in this case of 8%. If you actually purchase the property as part of the strategy, so say there's someone on this call right now, they own their primary residence and they're looking at doing their first RTO with Zach, and they purchase the property as part of the strategy, the net wealth improvement over 25 years would be over 700,000. Now, this calculator, I use it all the time. Half of the time I'm doing these kind of debt conversion strategies, it really is focused around rental cash damming. Can we change it so that I can see everyone's face? Remove spotlight. There we go. And so, again, a lot of us have already bought into the concept of using real estate to create wealth, but we're missing this massive piece of like, hey, you've got this massive debt. Like your problem is taxes and interest. Taxes on your income, interest on your debt. This strategy helps optimize your portfolio from that perspective and put the money back in your back pocket instead of the banks and the governments. Now, what's really flipping cool, that Jason calls me up like, I know a few months ago, he's like, hey, Nick, would the Smith maneuver work with like what me and Zach do? And I'm like, oh man, I don't know, because there's complexities. An RTO has an end date and Smith maneuver is a long-term strategy. So I said, you know what? Leave it with me, Jason. I'm going to call Monique. And Monique and I connected and she's like, Nick, I bloody well think it can. And so that sent us down a pathway of the four of us over the last few months, like meeting pretty regularly to kind of work out how can we combine these things to create a multiplier effect. Now, I don't want to take away the hoo-ha. This is hoo-ha. I don't know where that came from. I'm going to pass this over to Monique. Sorry, guys. And she's going to kind of, actually, what do we do here? Do I just pass it straight to Monique or Jason or Zach? Do you guys come in and then do the handoff? No? Straight to Monique. Okay. So Monique's going to share her section, which is kind of looking more specifically and granularly at the RTO and what the RTO combined with cash damming could actually do.
All right. Before I say anything, Andrew, would you like to add anything quickly?
Oh shit! I'm so sorry, brother. Andrew, I love you, man. I don't know what could I say one thing? I didn't know you a few weeks ago or a few months ago, but now I don't know how I could do my business without you. I appreciate you, man. I'm sorry I forgot to hand it to you.
Yeah, I have a spot for you, Andrew. Don't worry, I'll be calling on you.
Okay, I don't want to steal Monique's thunder, but I just want to be the guy who puts stuff in context again. So if you have a mortgage outstanding, if you get $2,000 a month of rent, that's $24,000 a year that you can use for cash damming. So in the last couple of weeks, I've had 2 client examples where we cut their mortgage. It was fully converted within 3 to 5 years. So this strategy is really powerful because once you layer in 1, 2, 3, 4 rental properties, now you're up to maybe $10,000 a month of cash flow that you can tax dam. So you can convert the mortgage really fast. Like one of the issues with the plain Smith maneuver is it just takes a long time. It works really well, but it takes a long time. This speeds it up tremendously. This is by far the most powerful accelerator. Now you take that and you combine on top of it what Monique's about to talk about with the extra stuff you can do on the rent to own. And I'm not going to steal her thunder, but it's just another accelerator to an accelerator for the Smith maneuver. Like this is a fantastic combination. That's all I got.
All right.
Thank you, Andrew, and I apologize for not throwing to you. Thanks, buddy.
Okay, so right, so let's have a look. Let's go a little bit further. I'm going to share my screen with you quickly. So just to recap, you should see it now. Right, just confirm Nick and Andrew. Is it right?
Yeah, we can see it.
We always seem to, every single time when I'm presenting folks, there always seems to be a problem on the size of my screen. So always have
Nick
to
will
check.
still say bigger.
All right, so let's recap quickly
You
on the.
you nailed it, Monique. This one was perfect. You've obviously practiced.
All right, so let's recap quickly on the RTO structure. All right, where Zach was actually talking about to say, all right, you have your total investment of $53,000. The term period is 3 years. You got your profit coming in, and your annualized return is 18.25%. All right, it does not factor in the capital gains tax because ultimately you're going to be selling the property to the tenant buyer, and you will be subjected to capital gains tax. So taking that into consideration, your true return is actually 16.64%. But it's still amortized over 25 years. Your mortgage that you had for 25 years, it's still going to be 25 years because you've done nothing to your primary mortgage. Now, let's actually cash flow dam this strategy and let's look at the cash flow cycle quickly again, where you basically have your more regular mortgage payments coming in. And our case example was $2,500. You've got the rental income coming in of $2,400, which is coming from the RTO, but you also have that one-time prepayment, the option consideration that you're going to be getting up front. Now, if we change that strategy slightly by basically saying, you know what, I'm not going to use that $20,000 as part of my down payment calculation. I'm actually going to take that money and I'm actually going to use it as a prepayment into my primary mortgage together with the monthly rental that I'm going to get, and then have it re-advanced through my line of credit, pay the down payment, as well as cash flow dam the rental income. What is the impact going to be? Just by doing that alone, you can actually see that even though before any taxes, that's more or less the same par, right? You're getting 18.25 versus 18.33. But just doing the cash flow damming strategy alone, you're actually saving 11 years off your mortgage just for the 3-year term period that you're using your RTO. Your after-tax income or ROI is going to be 20.42. And why is that? Because you might be paying capital gains on the property when you sell it to the tenant buyer, but the interest that you're incurring on your line of credit is tax deductible. And you will be having tax savings in this particular scenario, nearly $7,200. And that increases your annualized ROI. And this is a classic case where you're thinking, you know what, cash flow damming is far better than actually taking it in as a standard approach. And that is I can't remember the French word for it. I call it the Tour de France, but it's not because that's a cycling thing, but
Pièce de résistance.
so bottom line, folks, is you can cash flow dam the RTO. It is the most, I basically say it's the most powerful accelerator that's available out there with regard to cash flow damming out of the whole Smith maneuver accelerators that's available. And case in point, I've got to be honest with you, I'll do 20.42% over 3 years any day, then putting the money in a GIC where I'm possibly going to get 4%, or putting it in a mutual fund where it's possibly going to be minus 4% or maybe 4%.
Mind if I get a clarification there on that? Did you say 20% over the 3 years or 20% per year over
Per
the 3
year.
years?
So 61.27%
Want to be sure.
over the 3-year time period, average annualized 20.42%.
And I want to add in just one thing, like, because I've been training on this for a good couple of years now. This is the stacking the cash damming is on its own is just, it's actually very, very good. But the killer, or the thing that just makes it the effect be multiplied, is that upfront premium that we can run through the plan to kind of jumpstart it, and it just creates this additional layer of efficiency that didn't previously exist. So cash damming and the RTO strategy actually pair exceptionally well together. Well done, Monique, on unfolding that for us.
Perfect.
Oh, I
Just
love
so
it.
everybody
I
knows,
love
we are
it.
going to have
I'm going to be doing it myself.
just to jump in quickly, Monique, we're going to be having an FAQ at the end, but I just thought because it's relevant just to jump in. Jonathan's just asked one quick question. Please hold all other questions to the end if you can, though. But do you have to do the cash flow damming when you set up the purchase originally? Or if you're an existing rent-to-own provider, can you still do this?
Oh, you can do it at any time period.
Yeah.
Ideally for the impact to be there, it's best to do it right at the beginning. But if you're already in the process, you can actually still do it. You can still benefit from it. The only problem is the initial option consideration that you get, because you're already down the road, you're going to lose out on that, but you can still cash flow dam everything else.
And then you can just recycle and repeat the process with the next one you roll into.
Thank you very much. All right, so let's jump in. Oh, I just lost my screen. So let's put, if you could, Andrew B, I wanted to make sure you had another chance to speak and to share everything on this. So you have a unique ability, a unique perspective as well. So I'm going to put you on the spot. Andrew did not know this was coming, so thank you for playing along by choice, I'm sure. Obviously, you have a unique perspective that you've owned a rent-owned company in the past, been a mortgage broker for I don't know how many years now, worked and our go-to specialist when it comes to investing mortgages. Where did you see, like you've obviously believed in rent-own, but what would you say is the biggest connection between the two from both of your experiences?
I mean, the first thing I thought of when you guys said, "Hey, how would it work if we combine rent own with the Smith maneuver and cash damming?" I just thought immediately rent to own, you just have more cash flow on a monthly basis, right? Because you have that extra option credit over and above the fair market rent typically. So that's just going to give you more to work with. So that was my initial thought. I didn't actually think about the cash flow of the initial option consideration. So I apologize if I'm not using the same jargon that you guys use on your deals, but that big chunk up front, that's like another accelerator because you just get this big lump sum right off the bat. It's almost like debt swapping it for those who are familiar with that. But yeah, it's just like a really great kickstart to convert a bunch of debt right off the bat. So this is a huge advantage to rent to own over just buying regular rental properties.
Excellent. And so I'm
And
going to bring
to add to that, and the reason is that this process of debt conversion, it gets incrementally better over time. The deductions and the refunds increase. And so by starting the plan with this lump sum, it creates those deductions and those refunds in a much faster way, which enables the results to be increased.
Excellent. And if you three don't mind, I've spotlighted all three of you. Sorry to leave you out of this one, particular Zach, just for a second here. I just want to make sure I'm understanding this correctly. So I'm a visual person, so I'm going to draw this out the same way my 6-year-old would. We have a rent to own. We have a potential tenant buyer here, and the whole goal is for them to own a home, right? That's the idea. Now, how the rent to own works is we match the tenant buyer with you as the investor. And as the investor, you go to the bank and you get the mortgage. And the bank goes and buys the rest of the house minus your 20% down. Now, of course, to offset the risk, we have the investor put a minimum of 4% down. That way they are committed, they're motivated, and they have incentive to keep it out of the landlord tenant board. How you make your profits, obviously, we purchase it for a set price and you buy it back at an increased amount, typically 3 to 5%, 5% being the most common, allowing you to make your money on the end. But because of the way the deal is structured, because the tenant buyer is going to pay for the mortgage, the insurance, the property tax, that will make up the so-called rent component. Plus, they're going to pay what we call an AOC, or well, for the sake of simplicity, we'll call it a credit, right? And that's part of their savings. So they're going to make a payment of both the rent and the rent credit. And with the down payment plus the credit, that equals their full down payment at the end of the program. Is everybody following that so far? I want to make sure I'm understanding the cash damming component of this, though. All right. So if I'm understanding the cash component, what you're saying, Andrew, Monique, and Nick, is that you're taking the 4% initially plus we're taking the rent and the rent credit combined, and we're adding this to the personal mortgage. Is that part I'm hearing? Now, how you're setting it up, obviously, Monique, you had it very clearly outlined on your Excel sheet. Am I understanding that correctly?
Well, it's more like you're subtracting because you're prepaying that against the personal
Yeah,
mortgage.
you're dumping it onto, but yeah, you're correct. Yeah.
So you're lowering the personal mortgage, and at the same time, you're increasing your HELOC, increasing the value or the available credit you have on your HELOC. You're then using your HELOC to turn around and pay that mortgage, insurance, and property tax. And as a result of that, you're turning positive or bad debt into good debt, taxable debt. You're getting the tax advantages from it. And are you still maintaining the cash flow?
Yep.
There's no change. There's no negative impact to cash flow at all. This actually improves cash flow and creates deductions that didn't previously exist
So
by using borrowed funds to service all expenses on the renter.
So in the case of an RTO, a rent to own versus a cash damming, I'll just use cash because I like the word. On the RTO side, you're getting high cash flow. Oh, forgetting how to spell. Can't spell and think at the same time, as Zach's known all too well. You're getting a high cash flow. On the cash damming side, you're getting bad debt and turning it into good debt. And you're using the same income. There's no difference on that. You're still keeping the high cash flow. You're just flowing it through the bad debt into good debt and back into your pocket. Am I correct?
Yeah.
In essence, yeah. And that's the debt conversion.
Perfect. On the RTO side, you're also getting no maintenance. I was second guessing my spelling for a second. So you're getting no maintenance because from that standpoint, the tenant buyer is responsible for it. In fact, I'll give you an example. Jason Inget is on the call. You're one of our investors, if I'm not mistaken. Don't mind leaving a comment in the chat. And Zach, while you're giving the case studies, I thought you'd be a perfect example because you recently had a client who, one, was unable to buy out, which I know is a common question we get, and two, had a insurance issue that happened. Jason, just in the chat box, who paid for that insurance deductible and any additional fees related to that incident when there was the water leak from the upstairs toilet? 100% the tenant buyer. And in the same scenario, because that particular tenant buyer needed a 6-month extension, we were able to extend it by 1 year. Did you hassle-free? Yeah, very hassle-free. For you. My team, not so much. But for you, easy. But on the same point, that exact same tenant buyer also had the issue that she needed an extra 6 months. Did your cash flow go down? Even though she bought in the height of the market. Get this right. She bought in the height of the market and needed a 6-month extension. Right? Is it still a good cash flow return? Did everything still work out? Were we able to get that exit strategy while keeping her in the home, keeping the cash flow in place, keeping her in the ability to not lose her deposit, and keeping it a positive investment? I just wanted to get verification and confirmation because it doesn't matter what I say. Let's actually talk to people who are doing it with us. So as you know, maintenance free and tax advantage. Right? And finally, we get the tenant buyers who are actually invested. No more LTV. Now, that's not a perfect scenario. There has been the odd case where we've been to the LTV, but we also have $20,000 or $30,000 of their down payment when they go there, right? On the 2 scenarios where that has actually happened, as well as you can organize your cash flow, right? True cash flow from the cash damming strategy. So if you're someone that's thinking about the idea of having the high cash flow while managing the debt, maintenance free while getting the tax advantages, increasing or decreasing your chance of ever dealing with the LTV or any of the problems that come from renting, while controlling the flow of your cash flow to better support your tax, then doesn't this sound like a no-brainer strategy? If that sounds like a really good strategy to you, if there's anything missing, do me a favor. Either say, yeah, this is like a no-brainer, or if you have any issues or any concerns, put those questions together because we're going to cover those next. But with that being said, Zach, I want to hand it back to you and thank everybody for joining us so far. And Zach, if you will take it away.
Thanks, Jason. Yeah, I mean, I appreciate the drawing the pictures, depending on how you guys like to learn. And as we get through it, let's put all the questions starting in the chat box. I love it. And I think one of the other things, I don't know if anyone touched on it, but Monique, correct me if I'm wrong. I was talking about this in the chat box, but also when the property sells, when the rent-to-own property sells to the tenant buyer, and there's that $10,000 profit from the sale, that can also be applied to the principal residence, if I'm not mistaken. Is that correct?
Any profits it can, but one of the big key criteria is from a CRA interest deductibility point of view is for the interest to be deductible, there has to be a reasonable expectation of income to be generated. If that income source goes, that debt needs to be repaid. So what you normally would do is from the proceeds of the sale, you would actually use those proceeds and pay back the HELOC.
I
Now,
see.
there will be certain situations where you still will have a HELOC balance, which is totally fine because you can leave it there because if you get another RTO, you
Yeah,
can actually start cash flow damming into that HELOC and you can continue with that interest deductibility. But you do
got it.
need to pay most of that HELOC back from the proceeds.
Got it. Got it. Thanks for clarifying. Maybe we can dive into that a little bit deeper as we get into it. But honestly, the reason that I brought, everybody together, like I know there's lots of investors on here that are currently working with us or, in the process of actually house shopping with the tenant buyers right now. And I'm also seeing, new faces like Donna, Susan, Claudette. I appreciate you guys and girls jumping on. The next steps from here, and there's one thing I'm getting from this is like, this is like a niche within a niche, right? Like it's not just the HELOC Smith maneuver strategy. We're also talking about rental damming, and then we're talking about doing it with the rent to own strategy. So it's super niche, and I have never seen anybody doing this before. Okay,
I
so what like I don't think any one of us have. That's why we're so excited. We're probably like like we're probably like real estate nerds to be quite honest, but like we're just really excited to share with you, all of you. And really the next steps from here is Nick and Andrew I'm gonna put up a Calendly link here in 1 second. And the next step, guys, is to just book a call with Nick and Andrew. And I think they're gonna do a dual call with you guys and really kind of dive deep into, is this gonna be a strategy that could work for you? Not just on the rent to own, maybe they're gonna do a full portfolio audit to see if, what your current portfolio is. Maybe you have I know Jonathan made a comment. He has a buy and hold right now that this strategy could work on. And it could also work for you if you have an ongoing rent to own with us or a rent to own coming up that you're looking to invest in. So that's really the first step, guys, is booking that call. We also are going to share while you're going through that process to book the call. You're going to need to do a little bit of homework before you show up on the call. Okay, that's our like ask for you. So there's some questions that you guys are going to need to answer so that when we get on the call, we're prepared with information that we're going to need to do the underwriting. Okay, so I'm going to go ahead and share the QR code right now, and then I'm going to get Jason to kind of take it away, and we'll get into some more Q&As. But this is really the first step. This is the first time we've ever offered anything like this before. So go ahead, scan this with your phone. I don't know if you have the link handy, Andrew. Maybe you can type that in the chat box. Just anyone that's looking to register, we'll put that link for you guys in the chat box. And as you guys are signing up right now, hopefully you made enough spots on your calendar there, guys. And we'll maybe Jason, you want to jump in? We'll get some FAQs going, and we're gonna stick around so that we can answer anything related to like Smith maneuver, rental damming, rent to own, whatever you guys need. We're here to support.
Perfect. And I'm just getting the link, making sure I've got the right one. I think I do. That should be it. Andrew, you're already on top of it. So awesome. So we're going to just bring up all the experts back onto the screen, make sure we can answer your question, because this is your chance. If you had something you've been sitting on, this is your chance to bring it up. Let's get the questions answered. As mentioned, as soon as you fill out that scan, the QR code, Zach, you can keep that up if you want, so people have a bit more time. But yeah, as you fill that out, it is going to take you to a page, landing page. Keeps it quite simple. Scan the code, pick the date, But please, please, please remember to fill out that form, or else your meeting will be canceled if it's not sent in within 24 hours. No docs, no talks. That's the rule, right? So you got to make sure that they have what they need in order to be efficient and effective. If I'm not mistaken, this is an absolutely complimentary call, correct, Nick? Andrew, Monique, is this?
Yeah, yeah.
Yeah.
I'll elaborate on it. So the form that we're asking you to provide, it's really just to get the data points that we need. Remember that calculator that I showed? The form that Andrew put together, you took my form and then made it better. Basically, it's just to capture the data we need in order to run the analysis. So that calculator that I did, the purpose of the call is for us to get on a call, analyze your portfolio in the context of the cash damming process, and to look at how it could be applied. So I guess just a message for everyone on the call, for anyone who's like an existing RTO client of Zach's and Jason's, we should be talking to 100% of you, right? To look at, particularly if you've got a debt on your primary and you've got at least one rental, one RTO, we should be running those numbers to see if that optimization can be applied. And then obviously for anyone else in the call that wants to do that as well is certainly welcome. Yeah, so that's the form. It shouldn't take you more than 10 minutes to complete. And then Andrew and I will go through that with you on a call, which would take about 30 minutes or so. And having the data ahead of the call means that we can build the calculator before the call so we can spend our time going through the analysis instead of being like, oh, and what's this payment and how much is this? It just saves the time, right?
Yeah, I've simplified it as well. It's really just your non-real estate assets and your real estate assets. It's not a full mortgage application. We're just going to assume you have good credit, assume that you qualify, as most people who are showing up to these types of calls at 6 p.m. on a weeknight tend to have. So we'll just assume you qualify and we'll run through it on that basis. If it makes sense to work together, then we'll worry about getting a full mortgage application. Sometimes it's a tweak with the existing lender. Sometimes it means we need to make some changes because if you don't have the right product, we got to get you the right product in order to enable this strategy.
Yeah, exactly. And
we have a couple of questions here, and I thought it'd be perfect timing. Did you have a comment to make first?
Well, I was going to just go to Adam W's question to answer it. It's a common question that comes up.
I was going to read.
Yeah,
it's a common question that comes up.
That.
Yeah, so I'm gonna take it. It's a common question. So on the front end, you're like, why that doesn't make sense? Like the let's say my primary residence mortgage is at prime minus 50. The HELOC's at prime plus 50. Like, what's the point in me paying down my primary and then pulling the money from the line of credit? It's important to recognize that the purpose of this process is debt conversion. We're converting a non-deductible debt to a tax-deductible debt. So I'll give you an example. At the moment, HELOC rate is probably going to be 5.7%. But let's say that person, you, Adam, would be on a marginal tax rate of 40%. You're going to get 40% of that money back come tax time. So we go 5.7, which is the HELOC rate, times 0.6, which is the delta. So the net rate is actually 3.42. So it's important to recognize that when you're debt converting into a HELOC, that HELOC is tax deductible, even though the rate on the HELOC is going to be most likely a bit higher than the rate on the mortgage. With the tax deduction, it's going to be less. With a caveat, we're in an interesting environment right now where some people still have crazy low rates of like 1.5 or 1.8, but we all know that rate's going to expire very soon. So Monique, did you want to add anything to that? But it's basically the tax deductibility that makes this whole thing work.
No, you got to cover.
Can I add one thing real quick? I don't know if Nick agrees on this because we haven't come across this yet, but once you actually start carrying a large amount of deductible debt on the HELOC, different products allow you to have multiple mortgage portions or term portions. So at that point, you can lock in a separate term portion for the deductible debt, and then that's going to bring you back to prime minus pricing. So you don't have to worry about carrying at prime plus. So there's a term for it. But anyways, that's something I like to do once we get up there. And it also helps people wrap their head around the idea that the interest rate number on the piece of paper is higher. Even though Nick just showed you on his iPhone, that's your actual after-tax cost of borrowing, and that's what matters.
Yeah, and just on that point, you want to be mindful, you're right. As you debt convert into the HELOC, at certain points, once the debt gets to a certain level, you could siphon it off and just convert it to an amortizing portion. Being mindful of when you do it in the year and when the term's up for renewal, so you don't end up with a bunch of mortgage segments with different terms on different years, right? That can get a bit confusing.
I have one client now who's trapped because he did that without thinking
so
about it. Trapped himself with CIBC, for example.
Yeah, so that's something to be mindful of. But
Okay, I just wanted to say, just so everybody knows, this is just an FAQ. If you, we appreciate your time, we appreciate your energy. If you want to drop off, you can. If you got the information, you already know this is the right choice for you, then by all means, if you want to drop off, get some food, take care of the kids, you can. But if you still have questions, we're going to make sure we go through those, and we're happy to have you stick around for that. Just wanted to say that to everybody, so no one thought that this continues. This is the bonus, the extra, and basically what you two are just talking about is the reason why that document that you get as soon as you fill out the form and you get the document. That's the reason why that document's so important. So sorry to jump in there, but I'll hand it back to you, Nick.
Yeah, so Roy, can investment borrowing amounts that are rolled into a mortgage be deductible? If you're referring to when you convert a HELOC into an amortizing mortgage, is it still deductible? 100%. It's the purpose that the funds are used for that determines the deductibility. Whether it's in a HELOC or an amortizing mortgage doesn't make a difference. The only point to note is that if it's in an amortizing mortgage, then you're going to be reducing that balance over time, and therefore the tax deductions will be reducing as well the refunds. There are other advanced strategies where we can then keep the whole thing going, but that's outside the context for this call. But the answer to your question, that was a long-winded way of saying yes, they are deductible. Yeah.
I have a question to jump in for Andrew. Maybe we can just revisit. We had an investor that I was actually explaining about this event tonight, and then I should have asked him first because he was like, "Actually, Zach, I don't have a mortgage. It's all paid off, and it's all a line of credit." Give him this whole spiel about why I should come tonight, and then he's like, "Oh, I don't have a mortgage." I was like, I probably should have started with that. But then after talking with you, Andrew, you mentioned there could, even if you don't have a mortgage, like it's all paid off, it's all a home equity line of credit. The gentleman we're talking about, I think he's owned his home for a little bit of time, so it's probably gone up in value. Do you want to share what your ideas was? Or
Yes. So in this case, does he actually owe any debt on that line of credit, or it's just free and clear, but he has a available line of credit limit?
I think he had I mean I can maybe PM you the name there, but I think he had a available line of credit with some debt on it because he's done a couple deals with us before.
Okay, so if there is some debt on it that was non-tax deductible because he had already borrowed that for his primary residence or a vacation or whatever, in that case there is some debt that we could convert, so we could use the Smith maneuver strategy. You DM me the name here, so now I know which client it is. In this case, this particular investor doesn't have any any non-tax deductible debt left. When we started working with him, he had a free and clear house with a line of credit set up on it. All we did was we increased the limit on the line of credit, so we had more room for investing. And then the balance that he now carries on that line of credit, it's because he's used that for investment purposes. So in his case, one of the suggestions we'll probably make is, all right, now that the dust has settled on those purchases, you refinanced after you guys did a BRRRR project, you know what that balance is outstanding. Now we probably want to convert that to a mortgage portion, because that's going to bring down his cost of borrowing.
Got it.
And just on that question, just to add to that piece, if I wanted to, let's say I paid off my primary residence, but wanted to get a cottage, just wanted to put that out there.
You can.
And I can see Monique grimacing because her favorite topic about short-term rentals is about to come up.
No, it wasn't going to be a short-term rental. It's a cottage to live in, right? Or are you going to do it?
Yes.
You're going to be a part-time STR/cottage.
Well, you tell me, but it sounds about right.
Yeah. Monique, it's funny because we've been talking about this a lot today already. It's a trigger point for Monique. But yeah, you can 100%. You can. So I think the question. Let me just jump in. The question was like, what can you do if you've already converted all your debt? Well, you know what? You don't need the Smith maneuver because the Smith maneuver is a debt conversion process. But you can naturally leverage your equity, and as long as it's used for investment purposes, 100% of the debt's tax deductible. I personally like it. This is a personal preference and what you're comfortable with. Some people just love having their home free and clear. But it's debt equity. You can be putting that equity to work where it's going to produce a lot more revenue and growth relative to the cost. Like if you can borrow it at 5.7%, that's fully tax deductible, making your net cost of borrowing 3.42, and you can earn 10%. Is that a good? You can borrow at 3.5 and earn 10. Is that a good investment to make? I think so. It's a personal preference on risk, right?
Can we go back to the original question for a second, though? If they're taking money from their primary residence to go and buy a cottage, assuming they need the down payment for the cottage, that's going to be non-deductible debt, right? So now they've reestablished some new non-deductible debt, and now they could run the Smith maneuver or cash damming to help clear off the non-deductible debt that they used to fund a cottage. So this is kind of like another stage in someone's life, right? First-time home buyer comes to you with 5% down, they can't get a readvanceable mortgage. until they have 20% equity. A lot of times on that first renewal, they can already get the 20% equity, set up a readvanceable mortgage, start running some of these advanced strategies. Then they get to a point in their life where they're ready to buy a cottage, right? They might have knocked off most of the mortgage, but now they need to borrow for the down payment on that. And now they've put themselves in a position where they want to run the Smith maneuver or some of the other strategies again. So it's as long as you have non-deductible debt, you can use these strategies to help convert that debt.
Yeah.
So one of the other questions that had come up, did you have a comment? I heard Monique there, maybe not. No, one of the other questions that came up, I think it was also Jeff a little bit earlier. What about if you have, if you're below, what if you're not below, let me get this right. So sure, as long as you're below the maximum amount you can put against your primary mortgage over and above the current payments. So if you've maxed out your payments you can make on your personal mortgage, does that ever come into a factor, or is there a way around that?
Well, there's ways around it. Yeah, and the two of them can discuss that.
Sorry, so the question is, what happens if you've maxed out your prepayment privileges?
Correct.
Yeah.
Well, so let's for starters, the prepayment privileges between lenders are different. So I'll just give you an example. Scotia will allow you to prepay 20% of the original mortgage balance per year, plus double up your payment, plus add 20% to the base payment per year. That creates some fairly substantial room that you can run the cash damming process with. But naturally, sometimes, and this happens, sometimes you have a client that has so much rental revenue that they will exceed if they were to run it all through the strategy, they would actually exceed their prepayment privileges. That needs to be looked at on a case-by-case basis. You know, do you cash dam what you can and then keep the rest aside and pay for it separately? Do you maybe restructure it into a product like the Manulife One and have a larger portion in a HELOC that allows you to apply the process without hitting the prepayment privileges? That is there a specific question, like a specific scenario? Like when you said, is this a scenario where someone's actually maxed out their prepayment privileges? Because it's generally rare for people to have maxed them out, to be honest.
Or maybe they started with the wrong lender, right?
Like I can use me as an example because I'm
okay.
actually.
You're right. Yeah. You are maxed out.
I am one of those people. I use the prepayment privilege and I use the matching, and my rental income actually exceeds my prepayment privilege as well as the matching concept by $30,000 every year. It cost me $330 just to pay for that prepayment extra, but it saves me $5,000 worth of interest every year. I'll pay the $330 every time with pleasure because I don't want to pay the bank $5,000.
And all you got to do is, if any amount above the prepayment privilege is calculated at likely a 3-month interest penalty on the amount above the prepayment, which hopefully isn't that much. But Andrew, I just cut you off, buddy.
Yeah, so there's two examples. I've also seen this recently. So generally, if I'm going to give a general rule, the earlier you are in your mortgage term, the more likely it makes sense to do this. If you're 6 months away from renewal, it doesn't make sense to pay a 3-month interest penalty to start saving on that interest. But if you've got 4.5 years left, now you have a whole lot more time to make up for that extra interest, right? So the longer you have left in the term, the more likely it's going to make sense to actually incur a prepayment penalty. And then the other thing is if you have a fixed rate mortgage with an interest rate differential penalty, because interest rates have dropped recently, you could have more than the 3-month penalty. So really it comes down to running the numbers and figuring out what's the net benefit of doing it. And that's what we're all here to help with.
Which is another reason why I'm assuming he's put this complimentary offer together. So if you haven't done so already, I just dropped the link in the chat box again. Be sure to fill it out, fill out the paperwork, schedule a time with Nick and Andrew so that you can get your specific situation analyzed. Because if one thing's coming clear is that everybody here knows what they're talking about and can give you some advice that you probably haven't thought of. Where, as you said earlier in the call, Nick, a lot of people, I've heard a lot of people try the Smith maneuver or the rental cash damming, and they tried to do it themselves, set it up themselves, only to find out that the CRA did not accept it. Because there's a very specific regulation you have to follow when it comes to how this is structured, is it not? If I'm not mistaken, there's an actual document.
On the surface, it seems simple, and it is, but there's a lot of complexity contained within that simplicity. And you need someone like the deeper me, Monique, and Andrew dive into this, like the different ways it can be applied and the subtle nuances are, and each client scenario is very different. So yeah. And one thing I just wanted to mention, so one thing you'll get out of the meeting is, we'll just be very clear, like it's going to work or it's not going to work, but we'll be able to show you like what are the tax refunds going to be, what's the debt conversion point going to be, what's your potential mortgage freedom going to be? So the calculator allows us to produce very specific results, which can help, because we can sometimes understand a concept like, oh, okay, I get it. I prepay this, I move it over here, I do this, and I save money. But the calculator that we've got allows us to get very precise with producing the results, and what impact it will have on your portfolio.
Excellent. So we have time for one more question. So the next person who drops it into the chat box down below gets the question answered. In the time being, I just want to thank you all so much. It's been an absolute honor working with you and brainstorming this for the last few months. It's every single time, 5 minutes into the thing, you start learning something. And so I just wanted to thank you personally from the bottom of my heart. I'm so glad I made that call. Like I said to you once before, Nick, I was looking for you for 6 months. I just didn't know it was you I was looking for. So I'm so glad that we were brought together and that this was this was being
I
able
said
to
something similar to my wife.
Ooh, that sounds like a good thing. I might follow that. Let's see here. Yeah, bromance. So yeah, thanks so much. Do any of you have any final comments to share for the audience? Zach, Andrew, Monique, Nick?
Yeah, I'm just grateful for everyone making the time tonight. And it looks like, Andrew, you already got a call booked with Anna and Jennifer, Nick, Elliot, and yeah, so
Hey,
grab your
great to see you.
spot if you haven't already. And yeah, that's all on mind. So yeah, we'll wrap up, and we'll make sure to get you guys all the replay tomorrow. If you did join midway through, you'll have all the replays tomorrow. And appreciate everyone tonight, and we'll end it there.
Thanks, guys.
Bye, everyone.
Everyone.
Take care.